Welcome to Renew Power presents Pathway to a Fossil-Free India, partnered by ET Now. Now today I'm joined by an eminent panel of experts who will take on ESG financing in clean energy and find out if the answer to climate crisis lies in public capital markets. Are green financing and ESG investing mere buzzwords, or are they matters whose actual effectiveness is subject to fierce discussion? Now, in a post-COVID-19 world, the discussion on the interconnection between sustainability and the financial system has particularly intensified. We are joined by an eminent panel of experts to understand the urgency in acting upon climate change and global warming, and how ESG investing is a subject which we are likely to hear more of. Allow me to introduce my panel. We have Professor Vikram Gandhi with the Harvard Business School. We have Ms. Mody, the founder and managing partner at AZB Partners. And we have Sumant Sinha, the MD and chairman at ReNew Power. Ma'am, gentlemen, thank you so much for taking our time today. Mr. Sinha, I'd like to start with you. Now, you were recently at the COP summit in Glasgow, and the conversations around ESG seems to be gaining momentum. If you could tell us, what are the key changes that corporate India should brace itself for, and what are the key trends to look out for?
Yeah, thank you so much for that question. Yes, at COP26 this time, there were a number of, I think, much more heightened conversations within the corporate sector and the investing community about trying to really push forward the ball on the whole issue of sustainability without really waiting for the government and governments to act and come together and come up with whatever plans that they would come up with. And that was really heartening to see. And I was very positively encouraged by the enthusiasm and the energy with which the corporate sector was really throwing itself into trying to become part of the solution rather than becoming or being part of the problem. And there's a lot of conversation around higher standards of disclosure, which I think is going to be a very important issue. I think regulators will push for that as well as investors. And I think corporates will have to disclose a lot more in terms of their sustainability actions. And that will then in some ways become the benchmark for financing to come into corporates. And I think companies that do more on the ESG front will therefore position themselves more attractively for getting investments from the financial markets, and also thereby higher valuation. So I think it's really a good coming together potentially of what is good for the environment and what is eventually going to be good for companies as well. So I think in that sense, very encouraging to see a lot of the actions that come.
That's great to know, sir. Professor Gandhi, but do you think that climate action is finally gathering momentum with countries pledging to net zero goals recently? What should be done to ensure that countries convert promises and targets into action on the ground?
Yeah, thank you again for having me on this program. So yes, tremendous announcements, as Suman just said, at COP26, and very positive announcements both in terms of the government as well as on corporations. But the announcements are interesting on paper. The question is, how do you finance them? And that really will be the biggest challenge. I mean, I think if you think about what needs to kind of come together to achieve these targets, I mean, Morgan Stanley has put out a number of about $50 trillion of investment is required in climate over the next 10, 20 years. India talks about $1 trillion of that. And the question really is, how does that actually happen? And what you need is a combination of government policy and regulation, of execution at the corporate level, and investors coming together, seeing investable opportunities that actually generate a risk-adjusted rate of return. Otherwise, you're not going to see mainstream commercial capital come in. So I think the big challenge going forward, so one is, don't get me wrong in terms of what happened at COP26, while there's a lot of skepticism, oh, they didn't announce that, they didn't announce that. The fact of the matter is that an enormous progress was made, and let's not, perfect be the enemy of the good. And I think now it's all about the execution. And as far as India goes, if we want to put in $1 trillion into this, into the whole mechanism of decarbonizing the economy, it's going to be a combination of long-term capital, whether it be foreign or domestic. It's going to be a combination of government policy, things like carbon taxes and subsidies. Is it going to be a combination of companies really getting serious about it? Because, think about it, that most asset owners are long-term asset owners. And if they are now starting to factor in climate risk, other kinds of risk, and most of them think about, a quarter not as 90 days, but 25 years. And so companies too, if they want to have a strong investor base, need to change their capital allocation decisions. So I think it's not onus on one particular group, but all three really need to come together. And what is encouraging at COP26 is that there was a lot of dialogue between the three.
Absolutely, absolutely, Professor Gandhi. Ma'am, I want to come to you next. Now, an integrated ESG mandate for law firms today includes sustainable finance, climate change, human rights, and pretty much everything in between. What are your views on the emerging landscape? And do you think the Indian courts or the Indian legal fraternity, is it prepared to deal with this new paradigm?
So I think we don't yet, as you know, have one common platform where everything on ESG can be pulled in to be measured. But I think we've made good progress. So first you take the consultation paper that came out for mutual funds to invest in ESG compliant companies. So that's one push that SEBI is giving. The next, of course, is our BRSR reporting, which is voluntary for this year, but from next year for the top companies are going to have pretty detailed formats to disclose what sort of ESG standards they are achieving. Then you look at, from what I understand from what Times has only said, is that today we are the second largest growth market, apparently, Sumant will know better, for renewable power purchase agreements, simply because the push for corporate India and the government to invest in renewable energy is so high. So I think that, the stars are definitely aligning much more than I thought they would 5 years ago. If you look at Norway sending out a message that we will not invest in companies that are dirty according to them. If you look at the competitive tariff bids that are coming out in India, it was 12 rupees, now it's 2 rupees. If you look at the fact that renewable energy now has to be off-taken, you can't refuse to off-take renewable energy. You have to pay if you don't lift it. And then there are new changes in law coming about where in course of time you will be able to choose how you choose your distribution company. There'll be competitive forces at play there as well. Consumers will have a choice. Then you look at the huge renewable energy guzzlers like Amazon and Google, and data centers have become so prominent as an industry and as a practice area in India and can only grow with everything happening. So I see a good future ahead. Now, how fast, we don't know. We have 100 gigawatts. We promised we'll get to 175 gigawatts by 2022. I don't think that is happening. But the goal is ambitious. And the only way to get there is if all, the politics combine, the national policy combines, converges, India Inc. decides they want to go ahead. Even Coal India, which you're never going to sort of shut down ever, is going to have to find ways to reinvent itself, to wash itself better, to get the energy coming out of the ground cleaner. So I think it's positive. Now, again, these two gentlemen on the panel will know the reality is better than me. But the legislative framework and the government intention is positive.
Absolutely. And actually, I will now come to Mr. Sinha first and then Professor Gandhi to talk more about what you just said about the, so to say, the ground report. Mr. Sinha, there was a report that recently came out and it stated that India needs about 500 billion US dollars to help with its energy transition requirements. So what's happening on ground? Can you help us understand the size of the opportunity and contextualize the need for private capital in this space?
The Prime Minister has announced a target of 450 gigawatts of renewable energy capacity by 2030. We are currently, as Zia said, at 100 gigawatts of installed capacity. We need an additional 350 gigawatts at the very least. And that will require an investment in just in generation of about, let's say, $300 billion. In addition to that, we also need to invest in the transmission infrastructure, the distribution infrastructure, into battery systems and so on. And all of that will need an additional, perhaps, let's say, a couple of $100 billion. So the total amount of investment we require to get to the target is ballpark, let's say, $500 billion or $500 billion. So that's really what we require. Now the question is, where is that going to come from? Now, to give you a sense, India's entire banking system has advances of $1.5 trillion right now. So we need almost a third of that just in this sector over the next 9 years, admittedly. But it's far more than the Indian banking system is able to actually lend. And truth be told, at this point, Indian banks are not lending to our sector in the measure that they need to. And in fact, public sector banks are hardly lending to the renewable energy sector. So most of the financing is coming from the NBFCs like PFC and REC. It's coming from overseas debt markets, overseas bond markets, that is. To some extent, it's coming from other Indian private sector banks and NBFCs. And it is coming to some extent from international banks, but very small amounts. So I think each of these areas needs to grow substantially. And in addition to that, we need Indian large public sector banks to be lending to the sector as well, in large measure. People like SBI, the other public sector banks like Bank of Baroda, Canara Bank, Syndicate Bank, all these guys need to lend in large measure as well. Now, I recognize the fact that renewable energy projects require long-term funding, and the longer the better. And for banks, that obviously creates an asset liability mismatch problem. And so in some ways, banks are not the natural lenders to our sector, but just given the amount and scale of capacity required in our sector, we need funding to come from really from all sources. The one big missing piece in all of this really are the global multilaterals. And unfortunately, they are not lending very much to our sector. They are the ones who can actually lend at lower rates and for longer maturities. And I see that the issue that is happening is that while they don't have that much capital to lend from their own balance sheets, what they can do is essentially come up with creative products or innovative products such as country risk guarantees, or let's say discom risk payment issue guarantees, or some sort of FX hedging type of products. If they do that, if they cover certain parts of the total risk in lending to renewable energy projects, then that can actually bring, first of all, widen the pools very substantially, and also bring down the cost of borrowing. Now, that is something that is totally missing in action. And unfortunately, there is a lot of talk from multilaterals, but frankly, very little actual capacity that is coming down in terms of lending to our sector. And so I think that's an area that really needs to be speeded up.
So I want to move a little away from the pricing pact to just get to another point with ma'am. Ma'am, you mentioned this earlier in your first answer, and you were talking about that there is no single common platform to assess the impact of a firm's activity and the quality of disclosures. But do you think a single platform is even possible? And in the absence of it, how does one assess and mitigate the business and the reputation risks?
May not be that there can be one common platform. I accept that, and I think that it's probably very difficult to have an apples to apples across the board for companies. But I think, the market prices reputation, the market will price investment. And therefore, from the reportings, from the press push-ups that the companies give themselves, from actual numbers and outcomes which show the carbon footprint and basically how it's running from company to company. A demonstration today when you say that good governance has higher values. How do you judge good governance? The market judges it.
Absolutely. And Mr. Sinha, I'd like to get you in also, just taking this a little ahead, because what we're saying, so traditional models, it's difficult to factor in risk emanating from ESG into asset pricing, and not all ESG indicators can be converted into quantitative variables. How does one reconcile these factors? How do you get, the quantification of qualitative variables is tricky. So how do you reconcile this?
Well, just like you have credit rating agencies doing a subjective and a quantitative assessment of companies' credit ratings, I think similarly, you'll also have some degree of qualitative factors in an ESG rating. For example, in a credit rating situation, the rating agencies assess the ability and the willingness to make payments on their debt liabilities. Now, willingness is a bit of a subjective determination, and I think the same kind of judgments will have to be applied in certain ESG matrices which are not as quantifiable. But I don't think that will cause an issue. To my mind, rating agencies there are quite a few of them right now on the ESG sustainability side. They have been doing work for quite some time. They are now beginning to come out with ratings that are fairly well accepted by investors. These are also now, there are various ESG indices where companies have to become part of those indices if they want to attract ESG funds. So I think that whole ecosystem of ESG ratings, ESG indices, and companies, investors looking to invest in companies that have higher ESG ratings. So I feel that it's going to be something that companies will not be able to ignore in the future. They will have to have a very, very strong understanding of the whole ESG ratings situation and make sure that they have a focus on what their ratings are. Today, I don't think that a lot of companies are thinking about it as seriously as they need to. But tomorrow, as investors start pressing the rating agencies to start rating large corporates on ESG indices or ratings, immediately you'll have corporates beginning to get a lot more sensitive to the solution. So I think this is a sector that is actually going to explode quite substantially.
I would agree with that. If I may add one quick thing to what Sumant just said, the proliferation of ESG ratings is a really big positive development. My only comment would be that a little bit they're rear view mirror kind of ratings. And so they, look at the past or look at where you are today. I see a lot of investors now actually beefing up their risk management practices to really think about what's going to happen in this company in the next 10, 15 years, let's say the climate, because particularly for long asset owners. And if you think about it, pension plans, family offices which have multi-generational kind of a mindset, insurance companies, sovereign wealth funds, these are not short-term investors. These are long-term investors, and actually factoring in climate risk in a meaningful way is absolutely critical to their investment process, as is good governance or, the S factors, which have got more focus and credibility as a result of COVID, and the importance of equality, both income, ratio, the importance of how you operate in your community. And so what they're trying to do very, very aggressively is factor in through a mechanism called scenario analysis, really create different scenarios for their portfolio and for their investment companies based on these various ESG factors, see like what happens to this company 10 years from now, and what can we do, or what can the company do to actually mitigate it. And what they've become very aggressive on, and I hope you'll see this in India as well, is becoming a lot more aggressive on the proxy voting. So when they see that a company does not have a proper climate transition strategy to get to, I mean, everyone understands it can't happen overnight, et cetera, but not a proper strategy, just like you have a business strategy, et cetera, a proper climate strategy, they're starting to vote against those companies and vote against the directors, vote against the head of the risk management.
Fantastic. Well, we're just about running out of time, but I'll come to all the panelists for one last closing comment and a closing question. Ma'am, if I could start with you, just one thought is, is the constant worry about compliance. How can the government ensure compliance?
By enforcing it. What else? I think the cost of compliance can go up. I think that, there's one judgment that you guys may have, Sumant certainly, where because of the Great Indian Bustard, all the overhead lines are now supposed to go underground, and that is seen as a cost which can be passed on to the consumer as a change in law. So I think everybody has to get ready to pay more to comply, and that's, to save the world. But that's a reality, and how effective it will be is how committed the state governments and the regulator is committed to enforcing it.
Right, ma'am. Thank you for that. Mr. Sinha, critics often cite definition discrepancy and significant overlapping of assets under sustainable investing in the terms which are sustainable, ESG, green, climate, so and even responsible investing. They are all used synonymously. Your views on this?
I agree with you that they are, and there are many ways to describe, sustainability and ESG, and as you said, responsibility and so on. I think what matters less is the definition, and what matters more really is what actually companies are doing about it. And I think, as Vikram has pointed out, investors are setting up their own risk departments. They're going to be setting up their own assessments of whether companies are following any of these, whatever terminologies you want to use. And I think the substantive issue is that ESG activities will increase. and companies will be forced to look more seriously at all of their ESG activities. Um, and as we said earlier, investors are going to be a lot more diligent about looking at companies from that lens. ESG rating agencies will start, and governments will become more serious about enforcement, hopefully as well. So I think all of that is going to come together and really put pressure on companies a lot more than has been happening so far.
Well, we're hoping that too. And as we close the panel, I just come to Professor Gandhi, sir, for your closing comments. Just your thoughts on the way ahead. What can we hopefully expect?
Yeah, so I think the three key things. One is the disclosure, more consistency of disclosure, because ultimately what you measure is what you get in terms of behavior. I do think that we are seeing an alignment of investor interest globally to kind of, COP26 is a good first step, but to really kind of push this and be creative about it. And I think the other piece which has been missing partly is coordinated regulation around the world. I mean, I still do think that proper regulation with the right kind of carbon tax, I mean, it's all got to come together. The private markets, the government, companies, public policy, the community at large. I mean, I think a lot of companies are also influenced by their customers and their employees, younger folks like my kids. They're seriously conscious about this stuff, and more so. And so therefore that push, all that needs to come together. So, it's a doomsday scenario impending on us, and I'm hopeful that all these different constituents will come together. I tell my class at HBS that, while we call ourselves sustainable investing, it's incorporating impact and ESG into the investment process, that hopefully my class is redundant 5 years from now, because ESG is incorporated into everything, and it's not like some separate silo that kind of people talk about. So I hope we get there sooner rather than later.
Maybe it just becomes a way of life. And I'm sure if your class does become redundant, you will be teaching something even more better or even more interesting. But thank you so much, Professor Gandhi. Thank you, Ms. Mody. And thank you, Mr. Sinha, for your time. It's been an absolute pleasure interacting with you on our show, which is Renew Power Presents Pathway to a Fossil-Free India, partnered by ET Now. Great insights by our panels, and I'm sure our viewers out there have taken back home a lot of new points, a new way of thinking, and a lot of things that they will be giving thought to. Thank you so much for watching.